All of us know that higher timeframes matter. A small chart rarely changes a big trend. And yet we still end up trading against the bigger direction sometimes. Why? Because most of us naturally focus on the chart where we execute the trade. The 5-minute chart, the 15-minute chart, the 4-hour chart, and then we start building our assumptions from that small window of the market. That's where mistakes can start. So the real question is, how do we avoid that? In this video, we'll talk about a simple shift in perspective that can make chart reading much clearer and how trend stability and Trader's Aid helps you see when the bigger picture is actually aligned. Think about how we usually approach charts. Most of us look first at the chart where we enter or exit a trade. But the time frame where we execute a trade is usually not the one controlling the trend. In practice, it often works better the other way around. First, we gotta understand the bigger trend. And then afterwards, we can use smaller time frames to decide when it makes sense to act. A simple way to think about this is a river. Small time frames show the waves on the surface. Higher time frames show the broad direction of the river. If we only watch the waves, things can look messy and random. But once we zoom out, the flow becomes much clearer. That idea is exactly why Trader's Aid was built, to help traders stay objective and keep the bigger picture visible. Inside Trader's Aid, there are two different ways to approach the market. For traders who like to look for very early turning points, the red and green warning dots are often more suitable. They try to highlight moments where the market might start changing direction. The trend stability works a little different. It's more useful for traders or investors who prefer to see a trend that is already established. Trend stability helps show when multiple timeframes start pointing in the same direction. When that happens, the market often becomes more stable and easier to read. Let's take a quick look on how trend stability actually works. At the bottom of the chart, there are 3 rows. Each row represents one timeframe. The top row represents the timeframe we're currently looking at. So, if we're on a 15-minute chart, that row shows whether the 15-minute trend is pointing up, sideways, or down according to the algorithm. The second row shows the higher reference timeframe. This timeframe is roughly 3 or 4 times larger than the chart we're looking at. So on a 15-minute chart, this will be representing the 1-hour timeframe. The third row shows an even higher timeframe. Again, roughly 3 to 4 times larger. This row represents the bigger market context. Now look at the square at the bottom. This square summarizes everything above. If we don't want to read each row individually, we can simply look at the square. Gray means the market is neutral, so it can be choppy. Red means the trend is down. Green means the trend is up. This square represents the final market state. The same information also appears on the dashboard on the top right of the chart. For the market state to turn up or down, 2 things need to align. First, 2 out of the 3 timeframes need to point at the same direction. Second, the adaptive smoothing channel needs to confirm that direction. When those things align, the trend often becomes clearer and more stable. Neither approach is better or worse. Many traders simply combine them, for example, opening a first position when a warning dot appears, and later adding more once trend stability confirms the trend. The same idea can apply when leaving a trade. Trading doesn't have to be always 100% in or 100% out. When trend stability weakens, it can simply be a moment to reduce exposure, tighten stops, or take partial profits. Because in the end, trading isn't about predicting the future. It's about making decisions where the potential reward is larger than the risk. And that becomes much easier when the bigger picture is visible. So before focusing on the chart where we execute a trade, it often helps to zoom out first. Or use something like the Trader's Aid Trend Stability, which can help you to keep the bigger picture always visible. Thanks for watching and looking forward to see you next time.